Then we'll get started. Hey guys, thank you guys for taking your time and joining us today. We're here with a very special guest, Kevin Nichols. For whoever read my book, The Alternative Investment Almanac, one of the first couple of chapters was on life insurance policies. And this is one of the asset classes that many people didn't even know that it was actually out there, that there is this ability to actually buy other people's life insurance settlements. And Kevin's going to get into kind of some of the origin of how it actually ever even became an asset class. So Kevin was someone I reached out to a few years back when I wanted to include this asset class in my book. It is one of, full disclaimer, is one of the only asset classes that were in my book that I actually personally have not invested in, but I did want to learn more about it. So I wanted to kill two birds with one stone. And the research that I needed to do for my book, I actually was the same research I would have done as an investor, as a passive investor anyway. So when I reached out to Kevin, Kevin was one of the most willing and generous participants in my book. He not only participated in the Q&A section, he gave me some really valuable feedback, not only in the content of the actual chapter, but there was one section in particular, was my bad apples chapter. And Kevin actually had inside knowledge of the actual situation that I found online. And because of the way he shed light, I feel like I had a much more balanced opinion at the end with the chapter. So Kevin's usually, if anybody ever contacts me, because we don't have anything at SIH Capital Group for life insurance settlements, anybody that ever contacts me, I usually introduce them right to Kevin. And that's basically it, Kevin. I'll hand it over to you. Thank you so much for taking your time, and I'm really looking forward to this conversation.
Sure, absolutely, and it's good to be with you. So for those of your viewers or listeners who are not familiar with life settlements, the life settlement investment is where someone who owns a life insurance policy, they either no longer can afford it, they don't need it, they have no use for it, and they want to sell it. Generally, these are policies that don't have cash value. Sometimes they can have cash value, in which case we usually advise them to go contact the insurance company to see about selling it to them. But they ultimately are going to get a better deal selling it on the secondary market to someone like us. We always pay, and I say always. We have a saying in this business, never say never and never say always, but I'm saying always. We always give them more than the cash value for the policy. Say, for example, grandma has she's in her late 80s and she has an estate, and she's concerned about what happens to that estate when she passes. And so she may decide that she wants to speak with a financial advisor, an estate planning attorney, perhaps, maybe to rid herself of that estate, get it out of her name, so that when she passes, the estate tax won't have near the impact on her heirs. Furthermore, she won't be forced to liquidate the estate, which may or may not include business holdings, land holdings that she doesn't want to have liquidated in order to pay the estate tax. And so what she'll do is she will frequently get a term insurance policy, which is going to be fairly large, usually $2 to $3 million, and it's going to be fairly expensive because she's older, very much older. And then as she begins to liquidate her estate, using under the advice of her estate planning attorney, what will happen is after a couple, 3 years, she'll no longer have need of that policy. And so rather than just letting it lapse and having paid those premiums for no reason, that is now an asset that she can sell. Now, one of the things that is important here is we don't buy term insurance policies for obvious reasons. Term insurance, of course, has its place, but for our purposes, having a policy that has the ability to term out or not be renewable is not acceptable at all. So most term insurance policies have what's called a convertibility rider, which says if you decide that you want to convert this policy from a term policy to a universal life policy anytime before age X, you can do so without showing evidence of insurability. In other words, you don't have to re-qualify for the policy. And so they will convert that policy from a term insurance policy to a universal life policy, which guarantees that it's now renewable up to age 105, 110, 120 sometimes. Now, of course, the premiums will go up, but it's a known dollar amount that we can then calculate and decide whether or not it's going to be a policy that we're going to be interested in. So we would make an offer on the policy. And then if she and her team accept that offer, we would utilize the services of what's called a life settlement provider, which is required in all 50 states in this country, which includes a law firm, by the way. It's kind of like an escrow for the purchase of a life insurance policy. We would then make sure that the policy has no liens on it, that it's in fact been converted to a universal life policy. We would get a current illustration on the policy to see what the premiums are going to be going forward. And then we would decide if we wanted to buy the policy. If so, we would fund the escrow. And once she has completed all of the necessary due diligence from us, in other words, she signed off on it and the insurance company has signed off on it as well, then we would then own the policy and we would make our fund the owners and the beneficiaries as well. So this investment class, this asset class, first came about back in 1911. There was a case known as Grigsby versus Russell, in which a physician or a patient needed a surgery and he didn't have the money for it. And so he offered his physician his life insurance policy in lieu of payment. And the physician accepted that. He took the policy, continued to make the premium payments on it. And when the gentleman passed a few years later, he went to collect on the death benefit on the policy. The company then, this having never happened in the past or prior to this, the company contested and said, no, you don't have an insurable interest in the policy. And so you can't, he couldn't sell it. And so this case went all the way to the Supreme Court. Again, it's Grigsby versus Russell, 1911. And the Supreme Court handed down their decision, and the decision was written by none other than Oliver Wendell Holmes. And essentially it stated that once a life insurance policy has passed the contestability period, which is typically 2 years, it is personal property and it can be done with as the owner chooses. And there does not have to be evidence of insurability. There only had to be evidence of insurability or a relationship when the policy was taken out. So the insurance company lost, and that case has held, that court ruling has held since then. And it has been, there have been companies that have tried to contest and have gone to the Supreme Court again. And it has always held up, stating that once a policy passes the contestability period of 2 years, it's personal property and people can do with as they choose. And I said evidence of insurability. What there is a clause in any insurance policy that is written today where the people have to have an insurable interest. In other words, I couldn't take out a life insurance policy on you because I have no insurable interest. And so you'd have to take it out on yourself. Someone else could do it. But if later you decided to sell it, insurable interest is waived after 2 years. And so, so we buy these policies and we pool them. We pool money from investors, and we buy, a typical fund will have anywhere from 30 to 50 life insurance policies in it. Typically the death benefit is around 4.5 to 5 times the amount of money that we raise. And the average age of the insureds in these policies is anywhere from 92 to 94 years old. So and the reason we choose that age group is because we don't have to worry so much about or be so concerned about what their current health condition is, because in truth, what is the life expectancy of a currently or a perfectly healthy 93-year-old? And the answer is probably not more than 4 years or so. Now, of course, that's not always the case, but that's typically that's going to be the case. Now, so we get a lot of information. We do have medically underwritten life expectancy estimates that we pay for to have done by independent companies that will evaluate the health records of the insured, and they'll give us their opinion as to what the life expectancy of the individual is. And so we get 2 of those, and then we use actuarial data from the Center for Disease Control. The U.S. government puts out CDC actuarial tables. We subscribe to that, as well as an actuarial group called VBT, or Valuation Basic Tables, which the insurance company pays for and uses when they underwrite policies. And so the VBT is the most conservative of all of the actuarial data, and we'll use all that different input in making our buying decision as to whether or not the policy is going to be suitable for our investors. And so once we buy the policy, we'll make the premium payments on it until the individual passes. And once they pass, the policy is paid out to our custodian. We have a third-party custodian on every fund. We use Bank of Utah. We don't ever touch an investor's money. We don't ever even have access to it. So everything gets paid to Bank of Utah, and then we will decide whether or not we will make a distribution directly to the investors, or if that money will be held in reserve for future premiums. Typically, say for example, we have a $10 million fund where we raise $10 million, generally what we'll do is we will deploy roughly $6 million of those dollars into the marketplace to buy insurance policies. And we will be looking for, like I said, around $40 to $45 million, or 4 to 4.5 to 1 for as what we call an equity multiplier. But we're only going to spend about 6, because we're going to reserve about 4 million, or 40% of what we raise. We're going to reserve that for premium payments for the first 2 to 2.5 years. Then as policies mature, that money is used to replenish that premium reserve account until we hit about year 4 or 5. In that range, we hit kind of a tipping point, as I think it's Malcolm Gladwell said, the tipping point, where we have enough money in cash in the fund, and we no longer have the premium load that we did early in the fund, and so we're able to distribute to investors on a quarterly basis. So that just goes directly back to the investor into their account. Probably 80 to 85% of the investors in our funds are investing through self-directed IRAs. We have quite a bit of money through family offices, family trusts. There's probably some fairly well-known names, East Coast names that I'm not going to mention, but it's a very common and very popular investment for them as well. So we've been doing this now for 13 years. We invest in every fund right alongside the investors. We've never had a policy pay less than we have expected. We've never had an insurance lose a penny in any of our funds to this point, nor do we intend to.
Kevin, let me jump in. So thank you so much I love the timeline you gave and how life insurance settlements started. One thing that I found fascinating when I was doing my research for the book was the role that a life insurance policy had in an average person's life in 1911, like how significant that policy was in terms of their overall asset allocation. Because one thing in 1911, I think the Federal Reserve came in 1914, so there was always a lot of bank turmoil. So a lot of people were storing a lot of their wealth in these insurance companies because these insurance companies had a way better track record than a lot of the banks that were around at that time. So a lot of in a like from a history buff and from an economic perspective, it was really fascinating, that decision, because that decision basically legitimized this as an actual asset. But in fact, a lot of the people at that time were using it as a storage of assets anyway, but that actually legitimized it. But it never really became mainstream after 1911 because stocks are just so much more, sexier, let's say, especially with the roaring 20s and 30s. You never saw life insurance policies go that way, right? So it kind of has that, over 100 years now that this asset has almost always been there, but the problem is mainstream doesn't really know that it's there. But so much of the hedge funds and institutional buyers and a lot of the bigger names like the Warren Buffett, they're out in this asset class, right, Kevin?
I'm gonna have to send you some cash for asking me that question, because that's a softball. And the funny thing is, Dennis, nobody ever asks me that. Usually I have to bring it up. So you bring up a couple different points. One, yes, this is an institutional investment primarily, and has been historically, because of the amount of capital that is needed to enter the market. You've got to have some deep pockets. Buffett and his company Berkshire are huge players in this asset class. If I listed the names of the companies, they're the who's who of financial institutions. The biggest investor today in this asset class, believe it or not, is AIG, which is another insurance company. And you might say, well, wait, why would they do that? Well, because they know how strong this asset is. They don't do it under their other name. They have a subsidiary do it, but they buy insurance policies from from individuals that are underwritten by other companies. So it's extremely strong. Bill and Melinda Gates Foundation invests heavily in this. Merrill Lynch, before they went sideways, got sideways with EFTs and ended up being absorbed by Bank of America, had an enormous amount of money in this asset class. Deutsche Bank has always been a big player in this asset class. So yes, it's historically been an institutional investment. When we created our first fund, the objective was to make it so that the average man could invest in this asset class. Unfortunately, we were not successful in doing that. In the way the SEC has structured things, you can't offer it to somebody that really isn't an accredited or at least a suitable or knowledgeable investor, which is fine. Most of the investors in all of our funds are accredited investors. We do have some suitable or knowledgeable investors in each fund, and we are allowed to take them as well. But the interesting thing that you brought up, which is the Federal Reserve Bank, or the Federal Reserve System, our banking system today. We have what is called a fractionalized banking system. In other words, if you go and put $100,000 in the bank today, they are only required to keep, let's say 10% liquid for you to withdraw. Now, it's actually less than that. But the point is, they don't have to keep that on hand. They loan it out, and they continue to loan it out. And if you looked at the way that the banking system works, it surprises me that banks ever go under if they do things right, because it's robbery, quite frankly. Now, even that being said, the Federal Deposit Insurance Corporation exists to insure bank deposits. And if I asked you how many times has the FDIC insurance been used in the last 10 years even, it's hundreds of times. It happens all the time. You hear about a bank that failed and the FDIC has to step in. Now, there is also a legal reserve system for insurance companies. And if I asked you how many times that has been used to bail out insurance companies on the federal level, the answer is 0. Because life insurance companies, if you take out $1 million life insurance policy, say $1 million death benefit, the company must have at all times 100% of the death benefit on hand for you to take for your beneficiaries to take should you pass. So now, why hasn't that been tapped? And the answer is probably different than you might think. Every state has an insurance board, and every state has companies that they have admitted into their company. So say we were sitting around a table and there were 10 of us, you and I and 8 other people, and we all had our own insurance companies. And the insurance commissioner for the state said, okay, well, today we're here talking and for our annual meeting, and ABC Insurance Company is now going out of business. So who among you would like to buy their assets? Now, bear in mind that 90% to 95% of all insurance policies lapse before they're ever paid. So it's, if Vegas could do this, if they had slot machines that would pay only 5 to 10% of the time, they would put as many of those slot machines in place as they possibly could. So here an insurance company gets to accept your money for, on average, 7 years. They'll accept your money as premium payment for 7 years, and then there's a 90% chance you're going to walk away and they owe you nothing. That's a great gig for the insurance companies, which is why they are so financially liquid, solvent, and strong. They are the strongest institutions in the entire world. So if of the 10 insurance companies sitting around the table with the insurance commissioner, say for the state of Texas, where I am, if nobody raised their hand and said, we will buy them, or we will buy their assets and their liabilities, but we will buy them. If nobody steps up, the insurance commissioner has the authority to say, okay, then I'm going to split this company up amongst all of you, and you will all take a portion. Because of that system, the legal reserve guarantee system for life insurance companies has never been tapped once. Since 1845, no B+ or better rated life insurance company has ever failed to pay on a death benefit. Now, have life insurance companies gone out of business? Sure they have, but they've always been absorbed by other companies. And that's why they have this golden goose status. They are still the strongest entities in the entire world.
And I'll just mention, we had one question I want to get to in a second, but I would also mention on the whole Warren Buffett thing, if anybody is a fan of his annual letter, I think I found there was a section, I believe it was in 2003, but it's in my chapter for sure. I could probably send down the email, but there's a whole section where Buffett himself actually talks about life insurance settlements. And mainly he was trying to change the perception that the industry had, where he was basically laying out why it's so beneficial for both the client and for the investor, and how it's truly a win-win situation. So if anybody's interested in that, I think if you Google Warren Buffett life insurance settlement annual report, it comes up. It came up pretty easily. So I did want to mention that quickly. But let me get to the question, Kevin. Can an heir sue this fund to get the money for themselves from this policy?
No. Well, in America, anybody can sue anybody for anything, truthfully. But we have the heirs. One of the first things we do when somebody approaches us, first of all, we don't ever deal face-to-face with the insured. We always use third parties. And excuse me, that's to protect the insured, and it's to protect us as well. One of the things that we do is we ask the beneficiaries of the policy if they would like to buy it, and they are certainly welcome to buy it, but most of them can't afford it, which you might expect. So in the process of our purchasing this policy, we always have the beneficiaries sign off that they understand that they are no longer going to be the beneficiary of the policy, and they have no legal claim to it, no legal right. So for them to sue us after that truly would be frivolous, and we would countersue quickly, and that would not be not be wise on their part. I see you have a question. What are the typical minimums, and what is the holding period? The minimums for our fund is $100,000 investment. The holding period is, given that the average age of the insureds is, say, 92 to 93, it's not likely that the funds are going to be around much more than 8 years or so. However, what I typically tell people is this: if you know for a fact that you are going to need that money inside of 10 years, don't invest it here. There are other things that you can invest in that are probably more suitable for you. This is not a cash flow investment. There is no provision for liquidity. It is a growth investment. Every single dollar is guaranteed by the written guarantee of an American A or better rated life insurance company. All of the premium reserve dollars are kept at an FDIC insured institution, who is also the custodian for the fund. They handle all of the money. So we will typically begin distributing after about year 4 or 5. But if for certain you know you're going to need it, then it's best to not invest it here, put it in something else. As I indicated earlier, the equity multiplier on these is about, we start at about 4 to 4.5 to 1, meaning that if we had a $10 million fund, we want to raise anywhere from, we want to purchase roughly $40 to $45 million in death benefit. Now that's a perfect world. Now, from there, you're going to have people that live longer, and that's going to eat into our growth. So if we start with a 4 or 4.5 to 1 equity multiplier, we know from experience that by the time we get to say year 8 or so, you will end up with anywhere from 3 to 3.5 times your investment in the fund. Of course, if everybody passed early, then you're going to end up with 4 to 4.5 times. But an equity multiplier for, say, 4 to 1, it gives us an initial equity multiplier of 4 to 1. It will end up giving us an ultimate end point of about 3 to 1. So a $100,000 investment can reasonably expect about $300,000 over the term of 8 years. Having never been exposed to the market, having never been exposed, I mean, your money's safe. We can't touch it. I think 3 times your investment over 8 years is a pretty good return. That being said, the target yield in all of our funds has been since the beginning and will continue to be 10 to 12% annualized net of fees. Our fee structure is extremely low. We charge 1.5% upfront to reimburse us as an organizational offering fee. As we set up, we bear the burden of the expenses of the fund upfront, and we pay that money out of pocket. The organizational and offering fee then serves to reimburse us for those expenses. We have also a 2.5% management fee that comes out on the back end. So as policies mature, we get 2.5% of the maturities. So if you looked at 1.5 points up front, 2.5 on the back, that's 4 points over an 8-year fund, roughly 0.5 point a year. I think is pretty reasonable. There are no recurring fees in our funds. We don't have any, we don't hit the fund for a minimum or a quarter point every year or anything like that. It's nonsense. Again, remember, when we first set this up, we set this, the way that these funds initially came into play, this is a true story. My business partner and I, we had been investing in what were known as fractional life insurance settlements, which is where you take, say, $1 million policy, and say someone wants to sell it for $300,000, and there's another $100,000 that need to be paid in premiums for the next few years. And so there's a $400,000 investment in this policy. And you may split it up amongst 10 people, 20 people, however many. Everybody puts in the same amount of money, and we all own a piece of this policy. Now, we each owned, and each of those pieces are called fractions. And we each owned several fractions of various policies. And he and I were playing golf together. In fact, it's the one time in the last 15 years that we've ever played golf together. He and I, he doesn't play golf. And so we were on the course, and we each got a text from the company that we were using. And I got a text that said, hey, one of the policies that you own, we need a premium call. In other words, we need more premium money. So I was going to have to spend some money. Okay, fine. And he got on the same day a notification that a policy had matured, and he was going to have some income. And I'm standing there looking down at my phone, laughing. And I said, man, wouldn't it be great if we could just pool all of our policies together? And that way, when one of us got a maturity, we both got to share in that. And if one of us had a premium call, we both got to share the burden of that. And so it would, we could smooth out the yield curve for ourselves and make it more predictable. And so we started looking into it. And long story short, we found out that we could do this. And so it took us 18 months. We actually wrote our own memorandum of private placement, which, for any of you that have done it, I mean, it's beyond a beating. But we didn't have the $125,000 to spend to have somebody write one for us. And so we wrote one, and we had it reviewed by several attorneys. And once we put it in place, our first investor, like I said, was my dad. And he invested in several funds for many years. But additionally, we had other clients who had purchased fractionalized life settlements through us as well. And so we said, look, would you like to exchange those into the fund, dollar for dollar? And you'll be giving up, a 1.5 points on the front end and 2.5 points on the back end, but it will put you in a pool where instead of having, these fractions, maybe you've got 4 or 5 fractions yourself. Now you own a piece of 500 of these fractions. And that's what we did to start with. And it worked out beautifully. And so we really never changed the structure of the funds at all, except that in the 5th fund, we started buying whole policies exclusively. We stopped buying fractions because whole policies yield more to the investor than fractions do, because when you're buying a fraction, you have somebody who's kind of a bundler in there, and they're taking a large chunk of it for themselves. And even though they were still profitable for us individually and in the funds, we knew that we could do better. And so we did. And so from Fund 5 on, in Fund 5, we changed our custodian from Provident Trust in Las Vegas, Nevada, to Bank of Utah in Salt Lake City. And in doing so, we were able to negotiate a better custodial fee for our investors. And so we actually lowered our organizational offering fee from 1.75% to 1.5%. And it's remained there ever since.
So Kevin, is it usually in the commercial real estate world, right? There's usually like a GP-LP split, let's say 70-30. In your case, you remove that for the simplicity of just an annual fee. Is that correct?
We have no annual fee. The only split we get is on the back end. We take 2.5% of the death benefit. That's it. It's so straightforward and so simple. It's boring.
And the other thing is on the equity multiple, you said that you project 10 to 12, so you times that by 8. That's like probably a 2x, a little over 2x. But in reality, your previous funds have been doing closer to 3x. So you for conservative purposes, you skew the numbers down to a 2x for expectation.
Yes, we would much rather under promise and over deliver than to change the target yield. Some of our funds do significantly better than the 10 to 12%.
Okay. Also, I think I want to elaborate a little bit on the air question about suing. I just wanted to maybe for you to clarify what a transaction actually looks like, because a lot of people might envision like a boiler room, calling grandpa and grandma and saying like, hey, hey, are you interested in selling? But in reality, it's a very professional transaction where you guys are at arm's length, and then you actually are bidding against the bigger players, like you mentioned, the AIGs and the Buffetts and all of that stuff, just to get it. So by the time you guys get it, it's gone through multiple channels, and it's, you, like you said, you stay far removed, right? That's how a typical transaction looks like.
Yes, by the time we look at a policy, the policy has been vetted rigorously and in many different ways. What's the strength of the insurance company? What's the age of the insured? What's the health of the insured? How old is the policy? The policy has to be beyond the contestability period. So we're looking at policies typically that are at least 3 years old. Has the insured made at least some of the premium payments themselves, or have they financed the entire thing? If they have financed the entire thing, we're out. We're not interested. But once you've established that the policy is in fact acceptable, then we use what is called a life settlement provider. In other words, we don't deal directly with the insured. That's what the life settlement provider does. If the insured is not represented by counsel, which we hope they are, but if they're not, the life settlement provider is required to give them counsel and be a fiduciary. And if your investors know what a fiduciary is, that standard is very high. So they are required to become a fiduciary on behalf of the seller of the policy. Now, probably half of the policies we buy are what we would call the secondary market. And in the examples that we've discussed to this point today, those were all secondary market policies. In other words, Grandma Jones wants to sell her policy. Her financial advisor or her estate planning attorney told her it was possible. And so they've reached out and they have contacted us, and we use a broker. A broker brings us these policies to look at. And if we indicate that we're interested, then we will run the numbers. We will request a HIPAA release so that we can get medical information on the insured, and we begin the process that way. Now, the other half of the policies that we buy are what are known as tertiary policies, where you may have a fund that owns the policy, and let's call it a buy box. Their policies that they're interested in really are only up to a certain point. They don't want the premiums to get out of control or to get very expensive because they don't have the money in reserve to make the premium payments. They only maybe reserve 5 to 10% for premium payments, whereas we reserve 40%. So it's a huge difference, and it's a completely different business model. So something that may no longer be acceptable in a fund once a person reaches a certain age, for them, it may be exactly right in our wheelhouse for what we're looking at. And if that's the case, we still use a life settlement provider to do the due diligence, et cetera, but you're no longer now dealing directly with the insured. We of course make sure that the policy, passes all the tests, and that the insurance company has, I apologize for that. I don't know what that is. I think I've got a lamp going out here. But the insurance company indicates they verify that there are no liens on the policy. The policy is not in grace. It has not lapsed, et cetera, et cetera. Furthermore, the insurance company gets documents signed off from the beneficiary stating that they will not contest this sale.
Got it. And I think he had a second part to that question was, have you ever made a capital call if the group overlived the estimate and more premiums were needed to be paid?
No. In 13 years of doing this, we've never had to make a capital call. Now, that's not to say that, we're that good at doing this. We're very conservative in the way we do it. Like I said, we reserve 40% of the money that we raise for premiums, but sometimes you get to the point where a policy is approaching the point where it will no longer be profitable. So we may elect to sell that policy off to another fund and recoup our money that way. So when you do that, you of course you get an influx of cash of capital, and you eliminate the premium expense, but you forego the growth of the death benefit. So that will also bring the equity multiplier down. So, and that's one of the ways that we manage the premiums in a fund, is by, when a policy gets to that point, we will unload it. For us, the key is yield to the investor. This is not a tax leveraged investment by any stretch. Money that comes into the fund in the form of death benefit is taxed as ordinary income. Now, if we sell a policy and we have a gain on that policy, that is then taxed as long-term capital gains, and we have had many of those. So it's the main thing is, what you're looking for is growth and yield to the investor.
Got it. Okay, so this is a good question we got from Rob. Are life insurance payments typically adjusted for inflation? If not, what are your thoughts on inflation effects on such funds?
No, they are not. And if not, I mean, no further comments necessary. They're not. There's no inflationary adjustment in these. What you're doing is you're buying your growth at a discount in advance. We know exactly what we're going to get paid for a policy when we buy it. What we don't know is when. We just notified yesterday of a policy we owned for 9 months, and it matured. Now I think we've had 6 policies that have matured inside the first month across the first 10 funds. So it's not that uncommon, but getting back to tax advantage or tax leveraged, or being able to adjust them for inflation, no, there's nothing we can do there.
You just hope that the total returns outweigh the inflation of the period, and saying,
exactly.
If we have 3x inflation in 8 years, we probably have bigger problems than the returns of one fund. Yeah, but
exactly. So
it's not, it doesn't have any fancy inflation hedge. It just has really solid total returns that should outperform inflation.
Yes, absolutely. It's when you're buying your growth at a steep discount like we do, there really is no provision for an inflation hedge. There's nothing we can do.
Got it. Okay. Second part of this question was, you mentioned that you don't buy policies whose premiums have been financed. Why?
We don't buy policies where all the premiums have been financed. The insured must make some of the payment themselves. And the reason why is because that is a point in which the insurance company may state that there was fraud when the policy at inception, when the policy was taken out, that they didn't even know the policy was in existence. They didn't make the premium payments. Somebody financed the premium payments through a banker or something else. And even though there may be no STOLI issues, and a STOLI stands for stranger originated life insurance. Even though there may be no issues, it raises the question. We prefer not to even have the question be possible. And if the insured made some of the payments, one of the payments, any of the payments, then that in fact is proof that they in fact were aware of the policy, and it wasn't purely originated by somebody who had no insurable interest to begin with.
So it's not a financial reason, it's a legal reason.
Correct.
Got it. Okay.
It's a legal and moral reason.
Understood. Now, in light of that question, I guess, I know that it's state by state, they have their own regulations. Are there certain states that are difficult that you wouldn't buy policies in, or in general, the tweaks? Because I know that when I was doing my research, the incontestable period was 2 years for some, somewhere as much as I think 4. But is there certain states that you're like, this is not worth it, or they're more or less you buy in all 50 states?
Yes, there are 2 states that we will not buy from for various reasons, and I prefer not to mention them.
Got it.
But there are 2 states. Now, there are many states that are difficult to do business with. And it really becomes an issue of registration. We have to register our fund in every state from which we have an investor. So if someone comes to us from the state of Idaho, in that particular fund, we have to then file a Form B, or I think it's a Form D with the state of Idaho, pay the fee, let them know that we have some of their citizens from the state who are going to be investing in our fund. Now, they may request that we jump through some hoops. That's fine. We do that all the time. The most difficult state to do business with as it relates to notification is very easy, and that's New York.
The blue sky filings.
Yep, they are without a doubt head and shoulders above the rest in terms of cost, in terms of redundancy. But we do it because we do have quite a few investors from the state of New York, so we do it every fund. So other than that,
I share your pain, Kevin. Our last investor was from the state of New York. I was not aware of the blue sky filing fees for the state of New York, and when I saw it, it literally took up like 10% of the investment proceeds.
Yeah,
so it was insane.
It's ridiculous. It's at least $1,500 to $2,000 to register in the state, and you're supposed to do it before you even have the investor. So someone is interested, they've indicated that they're interested in it. The state of New York wants us to then pay the fees in advance before the investor makes the investing decision, which is very painful, because if that investor then backs out and decides not to, well, you're registered at least. So the next guy that comes along from the state of New York you've already paid the fees. But yeah.
Another question we got: do you issue a K-1 every year based on resales or receipt of a death benefit?
Yes, we issue a K-1 every year to every investor in every fund, based upon the fair market value of the fund, what has happened, what income has occurred, what the status of the fund is. Yes, that happens every year.
Gotcha. Okay. So I know we had like a rough agenda, and I know we wanted to get through some of the topics. I think the one that I don't want to rush, maybe we'll do this for a future webinar, is the unique tax strategies that you could use, where I think I know what the strategy, I've seen a similar strategy in real estate, but I definitely want to do a deep dive on the next webinar where we actually get to spend some good time, because I know we'll get a lot of questions on that. So I don't want to confuse everybody in 5 minutes. So I think the other question we had was part of your appeal, and I think part of the reason why I was so attracted to your firm was, low asset management fees, all of the stuff that SIH Capital Group does. Now, one way to keep those fees low is by having a small team, because you don't have a huge executive team and everything like that. The flip side to that is, how do you mitigate the key member risk? Because it's just you and your partner if something happens to them.
Sure. Well, if say something were to happen, so if we had closed a fund, okay, in other words, we raised all the money, we purchased all the policies, and everything is now at the custodian. We have provision with Bank of Utah where they will simply manage it in conjunction with our CPA firm, our audit firm, to make sure that they've got 2 years of premiums in reserve at all times, and then they will distribute directly. What we do when a fund is closed is we advise them when maturities occur every quarter, we evaluate where we are, and we then tell them we think we need to hold this money for the premium reserve account to replenish it, or we've got enough, go ahead and distribute it based upon each member's pro rata share of the fund. If something were to happen to us before we were to close a fund, then what would occur is we would simply stop raising money, and we would simply stop buying policies, and the fund would end, or it would hold those policies that we have purchased to that point. So really, not much. We utilize third parties that we pay to optimize the premiums. In other words, we want to pay the absolute least amount of premium that we can. We do not want to build cash value in these policies. Sometimes we'll buy a policy that has cash value already in it. It's not often, but in fact, it's happening right now as I speak to you. We'll buy the policy, and the first thing we're going to do is take that cash value and use it to make the premium payments on the policy. We don't liquidate it and put it into the general premium reserve account, but we leave it there for that policy specifically. But if something were to happen to us during the raise period, then we would obviously stop raising money, and the fund would then close based upon all the investors and the investor dollars that were in the fund, and all of the policies that were held by the fund.
Thanks, Kevin. That's a great answer. And I think you guys are so innovative with the amount of separation you guys put between yourselves and the money, like almost every step of the way, like almost that if something would happen to you and your partner, the funds would kind of autopilot till they come to a close, which I think is absolutely brilliant. Well,
bear in mind that, these funds were something to happen to my partner and I. These funds are going to continue on. I indicated that we invest in every fund right alongside your investors. My family is going to rely on this money as well. So it needs to be on autopilot.
Got it. And Kevin, we did get a question. I'm not sure if you do 506Bs or 506Cs, because this might dictate how you answer this question. Is there a new fund open?
Yes. Well, let me rephrase. There is a fund open right now, and that is Fund 10. We are wrapping it up, and it will be closed, I would say, inside the next 4 weeks. And then at the time that it is officially closed, we will already have Fund 11 open. So we will always have a fund open for investors.
And do you do a 506B or 506C?
We use a B.
B. So it's important that anybody in this call that is interested, you guys wouldn't be able to probably go on for this fund, but you reach out because there's another fund coming and start, because Kevin needs to document that pre-existing relationship. So just make sure if this is of interest, reach out, have that introduction call, actually get to know Kevin on a more personal level.
Sure.
What I love about Kevin is it's consistent. It's not one of those, you're not getting one of those spiels where it's like, oh, we're raising for this deal, it's already sold out, don't miss out. It's not one of those. It's, hey, if you're interested in this asset class, it's a long-term investment, reach out, start building that relationship.
Yeah. We have a lot, there are a lot of, there's a lot of information out there. There are a lot of interviews that I've done. They can go to our website and view our online video presentation, which admittedly is dated. And that's at thpenumbraplan.com. There's a password required. It's penumbra, all lowercase. And then, just indicate where they heard about, the video. It's not open to the public. You can't just go there and watch it. We don't do any general solicitation. So you have to know somebody or know a way to find the videos in order to watch them. From there, we don't allow anybody to sell our fund. We have advisors. All of the money that we raise is raised from advisors referring people to us, but it's an introduce and walk away relationship. They don't sell. I'm the only one who sells the investment to investors. You have to come through me in order to get into the fund.
And Kevin, I think I just posted the link, right? The Penumbra plan.
Yeah,
what was the password?
Password is Penumbra, PENUMBRA, all lowercase. Yes.
All right. So I strongly recommend, and Kevin has a lot of YouTube videos out there where he goes on other people's webinars and talks about it. I think we just scratched the surface of life insurance settlements. Do your research, look up other providers as well, so you could compare it to what Kevin has. I always found Kevin to have the most refined product. We didn't talk about, why you guys choose the 90, 93 average age versus some of your competitors that go in the 70s and stuff like that, and what are the pros and cons. So I definitely think we have a great follow-up webinar that we can do for that. And that being said, I know it's 8 o'clock, top of the hours. Do we have any last minute questions? I think we had some really great questions. For those who joined a little bit late, I will get this on YouTube and send out the link. Kevin, if you want to send it to your investors as well, for them to get some, I guess, newer information. But otherwise, thank you guys so much for joining. Kevin, thank you so much for your time. Always appreciate you.
My pleasure, Dennis. Anytime.
All right, Kev. Take care, guys. Thank you guys for everybody for joining. Thanks, Kevin.
All right. Thank you, Dennis. That was good. Very good.
You got it. Well, I'll send you an email. We'll catch up, and then we'll
Sounds
put
great.
The follow-up, I guess,